Please join me in welcoming Rick Sharga, who is the Executive Vice President of Marketing at Realty Trac, the leading provider of foreclosure information for investors, consumers, and agents in the country. Rick is going to dive into what is happening now and what he is expecting in 2021, with consideration of the end of forbearance loans and a potential shift in the foreclosure and distressed property market. Welcome to Side, Rick.
Hi, I'd like to thank the SIDE team for inviting me back. It's always a pleasure to be part of the events that the organization is putting together. And congratulations on a remarkably successful year for the company. We entered and exited a recession in record time. If you go back to the second quarter of 2020, we saw the economy basically seize up. What was encouraging is what happened in the third quarter. We saw a similar record increase on a quarter-over-quarter basis of over 30%. And that's one of the things that's been very different about this recession from previous recessions. The black line you see on the left is all the jobs that were lost in the second quarter. And then almost a straight line recovery in the third quarter. The rate of job recovery has slowed down a bit. And you can see that happening as the line begins to curve. But if you want a point of comparison, if you look at what happened in the Great Recession, and that's the green line you're seeing just above that black line, look at how long it took for jobs to come back to where they were prior to the recession hitting. It was about a full decade. And the hope is coming out of this recession that the jobs will be recovered a lot more quickly. So one of the reasons this particular recession has not hit the housing market nearly as hard as prior recessions is because most of the pain has really been felt by renters rather than homeowners. The housing numbers have really been spared some of the pain they might have felt anytime you would have had this kind of job loss, this kind of deep recession. In fact, the pent-up demand from the first quarter actually manifested itself in increased sales as we got through the summer months and into the fall. And by the end of November, home sales were actually running ahead of 2019 on a year-over-year basis. We've seen the home sales increase despite historically low inventory. If you're looking at existing homes available for sale, the supply is at the lowest level it's ever been since they started actually tracking that number, which is keeping homes for home sales from being even higher than they really are. One of the things I do track is the number of people that are applying for loans. If you look at the red line running across the page here, those are 2020 purchase loan applications. And you can see that back around March, April, May, those numbers plummeted. But since the shelter-in-place orders were lifted, about 26% more people applied for loans than applied the prior year. So the demand has been just off the charts. So an Econ 101 refresher for all of us is if you're in a market with extraordinarily high demand and extraordinarily low inventory, it drives prices up. And that's certainly been true in the housing market where we've seen double-digit price increases for the last few months of 2020. One of the things to keep in mind about those home price increases is it doesn't mean that every house in the country is going up by 10, 12%. There's virtually no inventory available right now at low prices, entry-level buyer kind of properties. So the product mix is really heavily skewed toward more expensive properties. In any case, it's getting more and more expensive for people to get into the market. And what's important to keep in context is what we're seeing on the bottom chart. Even though home prices have been going up, affordability hasn't been hit quite as hard as you might expect because wage growth up until the pandemic was actually fairly consistent for the last few years. And also the impact of those historically low interest rates has had an amazing effect on affordability, hard to overstate. In fact, one of the odd things I saw in 2020 was that while we were setting record highs for the median price in homes, both nationally and in states like California, on a year-over-year basis, the average mortgage payment was going down for those home buyers. So really hard, again, to overstate the impact those low interest rates have had on home prices, on home affordability. That is not something that can go on indefinitely, however. If home prices keep going up 10% a month on a year-over-year basis, at some point you hit an affordability wall and things get pretty bad pretty quickly in terms of home buyers' ability to actually secure a transaction. New home sales were even stronger than existing home sales if you look at growth on a percentage basis. What's interesting about this is that, again, this was happening in spite of the fact that inventory was at record lows. A very high percentage of new home sales in 2020 were on properties that either hadn't started construction or were just starting construction but hadn't yet been finished. I want to spend some time on what's going on in the distressed property market, and because there is a lot of concern when you see the headlines about seriously delinquent loans at record highs. What I would suggest to you is that we wouldn't really necessarily need to worry as much about these numbers as we might have 10 years ago. And in fact, these seriously delinquent rates are really a factor caused by the government's forbearance program. That's the reason you've seen these serious delinquency rates spike. You can also see foreclosure activity at record lows. There's virtually nothing going into foreclosure today except vacant and abandoned properties due to the government moratoria, due to the forbearance program working exactly the way it's supposed to be working. About 8% of borrowers opted in at the peak of the program. That number is now down to around 5.5%. Still a lot of borrowers in forbearance, but a far cry from the worst case scenario. And in fact, since the beginning of the program, north of 20% of the people in forbearance have continued to make monthly payments even though they haven't had to. You can also see that the number of people requesting forbearance peaked at the very beginning of the program. And I would submit to you that if the situation were getting worse, you would have seen spikes at the end of April, the end of May, the end of June, the end of July, anytime that next month's mortgage payment was coming due. But as you can see, exactly the opposite has happened. To me, this suggests the program A is working exactly as it was supposed to work, giving people enough time to get back on their feet financially and work something out with their lender. And it also shows that fewer and fewer new people are coming into forbearance, which suggests we're seeing something of a recovery economically. 87% of the people who exited this program, they exited successfully. So some closing thoughts for you. The housing market surge we saw in 2020 should continue through 2021. We should see home prices continue to rise, but the rate that they're rising should begin to slow down as we see new inventory coming to market from the builders. We'll see default activity increase, but I'm not betting that we're going to see anything like what we saw during the Great Recession. I believe the commercial market's going to be hit harder this time than it is in most recessionary cycles. And ultimately, the performance of the market is going to depend almost entirely on how good we are at getting this virus under control. Wish you all the best for 2021 and hope to see you again soon.